All right, welcome to the Explainer. So today, we're kind of crashing a yacht party, metaphorically, of course. We're going to distill the absolute best wealth-building advice from a group of successful investors who were actually, at a party on one.
I mean, it's the ultimate question, right? If you could just ask a bunch of rich investors how they actually did it, what would they say? Well, somebody did just that. They cornered a whole group of them at a party. And their answers, yeah, they might surprise you.
So, here's how we're going to break it all down. Think of it like building a pyramid. We'll start with the foundation, the absolute must-haves. Then we'll work our way up through their different plays and finish at the very, very top.
Okay, let's get into it. Any good pyramid needs a rock-solid base, right? Well, for these investors, that foundation is built on two, and I mean this, brilliantly simple rules. The one piece of advice that just kept coming up over and over again was so simple it's almost boring. First, start as early as you possibly can. And second, and this is just as important, never stop. Make it a habit, something you do consistently, without even thinking about it. And this right here? This perfectly sums up just how powerful that simple, consistent approach is. One of the investors brought up Warren Buffett, maybe the greatest stock picker of all time. And even he plans to leave most of his wife's inheritance in a simple index fund. I mean, if it's good enough for the Buffetts, that's a pretty strong signal for the rest of us, isn't it? But it wasn't just about what to do, it was also about what not to do. They talked about the worst advice they'd ever heard. And topping the list, people telling you not to buy the index, usually because they think they're smarter than the entire market. They also warned about getting tangled up in overly complex products and those kind of empty motivational sayings.
Yeah, one guy was super blunt about something called an investment-linked policy, or ILP. He basically said, look, I've never seen a good one. He argued that there are just so many layers of fees and commissions, the agent gets a cut, the insurance company gets a cut, the investment firm gets a cut, that by the time everyone's paid, it's almost impossible for it to be a good deal for you, the person actually buying it.
All right, so we've got our foundation set. Let's start building the next level of our pyramid. Now we get to the big debate. What do you actually put your money into?
And this is where things got interesting, because there was a clear split in the room. You've got one camp taking the passive path. Just buy some diversified ETFs, set it, forget it, and let the market do its thing. And then you've got the other camp, the active path. They're out there hunting for individual stocks, taking on way more risk for the chance at a huge, massive reward.
So for the folks in the passive camp, a few names kept popping up. QQQ was a big one, which is basically a big bet on tech. Then there's Berkshire Hathaway. People see that as a safe haven, almost like its own little diversified company with a giant pile of cash. And one investor talked about a momentum ETF, which is designed to ride the wave of stocks that are already doing well.
But man, you just can't ignore the siren song of that active path. One investor shared this absolutely mind-blowing story, a 3,000% return on Palantir shares. They got in at around $7. I mean, come on, that's the kind of win that makes you dream, right? It's what keeps that whole idea of stock picking so exciting.
Okay, but hold on. Here comes the really important part. This same guy who hit that 3,000% home run on Palantir, he admitted that when you look at his actual total profits, in real dollars, the majority of his wealth still came from good old, boring index funds. How about that for perspective?
Now, this next point was a real light bulb moment in the conversation. It kind of shifts the whole focus away from investment returns and onto something that's way, way more powerful, especially when you're younger.
Here it is, the big takeaway. When you're just starting out and your portfolio is pretty small, don't get so obsessed with your investment returns. The single biggest lever you can pull to build wealth is your ability to earn more money. It all comes down to your income.
I mean, just look at the math. It's so clear. Let's say you get an amazing 10% return on a $10,000 portfolio. That's $1,000. Great. But what if you put that same energy into getting a $10,000 raise? Or you start a side hustle that brings in 10 grand? Well, that's $10,000 in your pocket. It's not even close. Your earning power just completely blows away your investment returns early on.
Okay, so if the game plan is to focus on income first, how does that actually get you to those big life-changing numbers? Well, the investors actually laid out a pretty clear blueprint for that too.
So that first big milestone for a lot of them was hitting $500,000. And let me tell you, the way they got there had nothing to do with finding some magical stock pick.
Nope. It was all about pure, raw earning power. We're talking a solid income from their main job, saving an insane amount of it, running multiple side hustles, all at the same time.
Some even used leverage, like buying property, to speed things up. It's a total grind for sure, but that's how you build up that first big chunk of money you need to get the ball rolling.
So once you've gone through that $500,000 grind, getting to your first million is where things start to get, well, magical. Your pile of money is finally big enough that compounding, that interest earning interest, really starts to take over and do the heavy lifting for you.
But what about the next level? How do you go from a millionaire to having, say, $10 million? On this point, pretty much everyone on that yacht agreed. The game completely changes.
Yeah, this quote really nails it. The consensus was just overwhelming. You don't get to that level of wealth from a salary. It doesn't matter how big it is. You don't get there from just passive investing either. You get there through entrepreneurship. You get there by building a real business.
And you have to ask, why is that? Well, it's because when you build a business, you're not just investing in an asset. You are creating the asset. You own it. Suddenly, your wealth isn't just about what the stock market does. It's about your company's value, its revenue, and that can scale up in a way that your personal portfolio just can't.
So there it is, the complete wealth pyramid, straight from the people who've actually climbed it. You start with that solid foundation of investing early and consistently. You accelerate your climb by focusing like a laser on your income, and you reach the very top, the peak, through the massive, scalable power of building a business. So, now you have the blueprint. The only question left is, where are you going to start?